There's a few benchmarks that we all know about. There's Brent, there's WTI, there's others, but those are the two that we talk about. If we transpose this to chips for a second, okay, let's say you have an H100 index. We did an episode of the podcast last week, I think, with the CEO of Cerberus, which is another...
It's an amazing company, yep.
Yeah, but they're another type of chip for inference. Is your assumption that these indices are going to be close enough to the cost such that if you're, okay, I'm running inference maybe on some Cerberus or TPUs or training, whatever, some of these others, that the market, that an H100 index will be good enough as a hedging instrument?
This is the whole goal for me sitting here, actually, right?
Okay.
There's a meaning for every financial products. The functional reason for commodity, it is for hedging, right? This speculation is great, but it's really for people to hedge their volatility, to do risk allocation, to do risk transfer, and then asset capital allocation. If we can't do, Joe, what you said, then we fail at our job.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
So, Joe, we're still continuing our series recorded from the live show in New York. We had a bunch of great conversations. A couple of them were building off of discussions that we had had previously. Yeah. And one of those discussions was in Chicago at another live show about 6 or 7 months ago, back in October. We spoke with Don Wilson of DRW about the trading environment, but also about his new venture.
Right. And so his new venture is one that actually there's quite a bit of competition in and quite of excitement in. And it's essentially like, okay, GPUs, we know they're very important for the AI boom, et cetera. The question is, can GPU capacity, which is scarce, can it become a tradable commodity such that I can buy futures to lock in my price of access to compute power? Could I resell those futures? Will there be speculators speculating on the up or down price of like an H100, running an H100 NVIDIA chip for an hour? This is a big question. We know there's a lot of interest in the actual compute, but whether there's interest in compute futures as tradable instruments is very TBD.
Yeah, and the analogy that everyone always uses is compute is the new oil, right? So why can't it have an oil, a market structure that looks somewhat like the oil market? And there are challenges. Fungibility is a big one. Like one chip might not necessarily be equal to another chip.
Or one chip, the same chip at one data center might not be equal to the same chip at a different data center.
Exactly. And so even if you're not interested in AI, what I say here is like the market structure questions and the idea of building an entirely new market is really fascinating to me. And I think others will find it interesting too. And we really do have the perfect guest. We're speaking with Carmen Li. She is the CEO of Compute Exchange and Silicon Data. These are the two companies that Wilson is invested in. And they've already announced that they're doing futures with the CME. So really the perfect person to speak to. So take a listen. All right. So some people might remember last October, we spoke with Don Wilson of DRW fame, and he was talking to us about his new project, which was basically building out this compute exchange. Now we're here with you 6 months later. You're actually the one leading it. How far are you in this endeavor? And remind us, what exactly are you trying to do here?
Yeah. So thank you for the great intro and great audience. Before I do that, I'm actually going to call back to 6 months ago in the Dawn podcast you did. You asked them a question, what if compute prices keep going to go up? At that time, September, October, compute prices were going down across all chips. Now see what happened. I think you called it. I think you called it, the market called it. So I'm the founder and CEO for Silicon Data. So that's the index provider for GPU indices. We recently announced partnership with CME. So we will be launching GPU future and options from CME in a couple of months, pending FTC approval, obviously. So that's quite exciting. We've been working on GPU indices for past 2.5 years, starting 2024 April. So it's been a while. And we launched world's first GPU indices at Bloomberg Terminal in 2025.
Oh, yeah.
A year later, we launched the partnership with CME, so it's quite exciting. Separately, I heard you mention Compute Exchange before, so thank you for doing that, Joel. I'm the CEO for Compute Exchange, which is spot marketplace for GPU procurement. So we do reserve contracts, forward contracts, as well as refurbished contracts.
Let's talk about the variety of options that we have to financialize compute and so forth. So who is this? I mean, this came up in our conversation, the first conversation we had with Ian Dunning. Who is the type of buyer who would want to buy compute on a spot market? Because, right, you talk about typically we think it's like these multi-year contracts where some entity enters into a contract with a data center or a neocloud, whatever, and they have this for a while. So who is the buyer or the user of these instruments that might want to buy spot compute or very short-term, short-dated compute futures?
It's a great question. So the compute market right now for Compute Exchange, we have all our provider mostly are neoclouds around the world. Okay. That's one side. Another side is a big variety from AI startup. So even though they are a startup, they spend millions of dollars on GPUs already. There are enterprises who are traditional businesses, but they are needing a node, 2 nodes, a few servers here and there for their inferencing or, I don't know, other deployment needs. They are providers, they are inferencing providers, right? They don't own GPUs, but they provide open source, open weights, model support for other use cases. So we see a big variety, most North American firms. They do a variety of combination of contracts. Obviously, on demand give you the most flexibility. You don't pay when you don't use it. However, you're also at the mercy of demand supply curve at any given time. So translate to your price can go from $3 to $6 to $9, depends on demand supply curve shifting. So that doesn't help when you can have a predictable margin. And also in terms of scarce, you're not guaranteed for GPU resources for next hour or next month. So you see a lot of people shifting from on-demand to reserve, even forward contracts, right? So forward contracts, you basically lock in a deliverables for next whatever month, right? Starting in September maybe, or starting November for variable opens, right? So this all comes because of market condition. So Compute Exchange cover that, the physical GPU procurement, also token. So we'll talk about token as well. On flip side, who's going to use the futures options can be a similar set of people, right? You look at oil market, which we all love WTI and Brent, right? The people use WTI and Brent, a lot of them are naturally long oil. So the shells, right? The producers, they need to hedge their revenue volatility by shorting futures or put options. If you're naturally short oil, American Airlines, right? They want to control their cost volatility. They want to obviously use future options as well. Simple to compute. Your neocloud or anyone have the servers. Ideally, you want to have predictable revenue streams.
So the neocloud would be the shell in this example.
Exactly.
Okay.
You have GPUs, right?
Yeah.
Or the banks where GPUs on your balance sheet, right? You're long GPUs. Then naturally, you want to make sure revenue, right, is stable to a certain degree, and then you want to use future to do so. If you are naturally short GPU, which is everybody in this room, unless you tell me you have GPUs, right? Then depends how much you use. If you want to control your cost volatility, you want to use future to hedge as well.
Just on the Compute Exchange side of things, if someone is buying like off the spot market, how do you guarantee, I'm not sure quality is the right word for this, but how do you guarantee they're getting what they expect?
This is a great question. So I'm going to flip to a slide if you don't mind.
Oh yeah, we have visuals
more
for this
slides,
one too.
yeah.
So I usually don't like to use slides, but this time, because you mentioned really good question, so we actually call it GPU lottery. So we published a paper early this year at GPU conference with Jefferson Lab on GPU performances. Well, actually, so we can happy to create a link and to the audience later on. This is A100, by the way. I know we didn't put tag on, but it's A100, 40 gigabytes memory bandwidth. We proved there's 38% performance variance for the same chip, and then we decompose it into the chip itself, intra-provider, and inter-provider. And there's many reasons for that, right? And to your point, you don't know until you get your GPUs. We have a Platts for GPU, CarFax for GPU, depends how you look at it. So in compute change, you actually verify the GPU before delivered to you. So basically, you can RFQ for say, hey, I want a 200 B200 nodes. Obviously, we'll give you specs back and the commercial back. Same time, independently verify the performances on flops, memory bandwidth, tokens, and other information, SLAs and other things. And as a user, you can decide, is price your most important criteria? Maybe it is. Or maybe you're willing to pay a premium for geolocation or the performances that you care more about on latency, right? We believe give people the option, and transparency is the most important thing.
So let's stick with the oil analogy for a second. There's a few benchmarks that we all know about. There's Brent, there's WTI, there's others, but those are the two that we talk about. If we transpose this to chips for a second, okay, let's say you have an H100 index. We did an episode of the podcast last week, I think, with the CEO of Cerberus, which is another...
It's an amazing company, yep.
Yeah, but there are another type of chip for inference. Is your assumption that these indices are going to be close enough to the cost such that if you're, okay, I'm running inference maybe on some Cerberus or TPUs or training, whatever, some of these others, that the market, that an H100 index will be good enough as a hedging instrument?
This is the whole goal for me sitting here, actually, right?
Okay.
There's a meaning for every financial products. The functional reason. For commodity, it is for hedging, right? This speculation is great, but really for people to hedge their volatility, to do risk allocation, to do risk transfer, and then asset capital allocation. If we can't do, Joe, what you said, then we fail at our job, right? So that's why we went all the way back. The way we develop our index model is not a simple math. It's not, hey, you have two H100 to simple average, right? Because then you compare apple to oranges. The two H100 can have different CPU, different RAM, different disk, different geolocation, different memory bandwidth. You cannot do simple math. What we do is we usually collect 6 months of historical trading data from over 100 data sources, and we see which factor drive the price differentiation. So every day, over 150,000 traded prices ingest our platform, and we normalize the traded prices based on different characteristics of the model itself, and normalize to a base case, and then we do the math of settlement prices calculation, right? So then this price will be highly correlated, ideally, as much as it can, to the price you pay at a neocloud, for example. However, it won't be the same, just like basis trading, right? Like every other commodity, there's a basis risk. We're helping client calculating the basis risk. So hey, you US East, you may be a bips higher or two, then there's expectation, a manageable correlation, understanding of the indices.
You mentioned volatility just then. I mean, the reason people need to hedge is because of volatility. Are you seeing enough of that in GPU prices that this model makes sense? Because if it's just a steady line up or steady line down, it's going to be a kind of boring market.
It is. So it's interesting. So last year, when GPU price all going down, the big conversation is, why do you need indices for something price will always go down? And this year is, why do you want indices when price always go up?
That's right.
Literally, this is all the question I get. It's pretty fascinating. So when we look at volatility, we'll look at daily volatility movement, not the price up and down, right? The daily volatility for A100, H100 is around 20 to 30. So it's a very healthy commodity volatility range. So I don't manage volatility. It just happened to be that volatility that can change. It's all because we normalize it. If you look at each individual chip configuration at different geolocation, the volatility are different. There are some chips with 80% volatility, some chips with over 100. Because normalization of indices, you actually get very healthy 20 to 30 daily vol.
Here's a question. I'm always fascinated by, we look at the Bloomberg terminal, for example, and there's a price on the screen, and it's just there. And we sort of take it for granted that it had to come from somewhere. And maybe some commodities have there's an existing exchange and a public price, and then there's also a lot of commodities that are just bilateral trades. What is the actual process by which you collect the most recent data? So if you say, okay, an hour of H100 usage costs X, right? Whatever it is right now. How did you assemble that number? How did you gather that information from, say, the inference providers?
So it is can be lengthy, depends on what data sources. The nature of GPU spot market, so compute exchange is one of them, and then many neoclouds, hyperscaler marketplaces all have very different contract size, duration, specs, and their way to manage their data, right? So it's a lot of a licensing conversation, negotiation, and also context about myself. I don't know, I was used for Bloomberg data. So I was in data business for a period of time. So everything is pretty intuitive to me. It's very important to get a variety of data sources, especially for compute.
Like, do you call them up? Like, so it's like, okay, the price is different on a Friday versus
you zoom them up.
Yeah.
You first have a conversation. Say, hey, I love what you do. You're great in your cloud. Can I license your data?
Okay.
And usually your feedback is, what is in for me?
Yeah.
Right. And then we'll talk about commercials. And then your concern could be, hey, if I give you all my data, I give away all my secrets. And then we'll go through traditional licensing agreement. What can I disclose? What I want from you? What I do not want from you? What's the pipeline look like? Are you use a straight bucket job? Are you writing my API to yours? Are you writing to mine? It's a lot of conversation. It's actually pretty standard conversation. And right now we have 8 million pricing points globally, around 200 data sources. It's pretty much BAU. A lot of people will say, hey, Carmen, always bring up, can I have your data? It's always my ending.
We were talking about GPU indices, and you're not the only one doing GPU price indices for sure.
Not anymore.
Yeah, not anymore. But when you look at some of the other ones, like sometimes they show different numbers or even different longer term trends. What accounts for the discrepancy there? What are you doing differently, or what are they doing differently, I guess?
So I can't comment on other people's methodology because I actually do not know. Different data, raw data, different methodology will eventually drive the different prices. So the way I would look at this is, it's always smart for anyone to look at multiple data sources and then figure out what is the actual decision you have to make, which data source do you trust. The market always vote. Once the things start trading, the market always gravitates towards things that actually help them hedge. Right? If you're easily manipulatable, if you are not a data source, people actually use you hedge, then what's the point aside from speculation, right? So, I love to say, I also strongly believe we're the best, but again, I will let the market decide, which will happen very soon.
So, of course, yes, there's the economic rationale for the existence of a hedging instrument. And we can understand that. Someone who is an entity that that needs compute, they're implicitly short GPUs, they want to hedge, etc. What are you seeing but the liquid markets also really do need speculators, and they need people betting on price. What are you seeing right now in terms of traders or institutions, etc., who economically can take both sides of the trade? And how active is this getting, where there's just a compute trading desk that is separate from their economic needs?
So the conversation has been going on for a very long time with various banks, various market participants, speculators. They're all very excited. So some banks obviously have both sides of the trade, right? Yeah. So they can cross off some positions internally. That's great. Obviously, some they have to leverage external products. So that's where we come in. The way I encourage them to do is, selfishly, I want them to start trading desk on compute. The more people trade, the better for me, right? Selfishly. But same time, it's important for people to understand GPU trading. It's not like you can't just move someone from trade all your electricity with no background context drop into GPU compute futures. There's a lot of context where, number one, GPU, it is not homogeneous product. Number two, you have to understand the use cases for A100, H100. Right now, they're not that correlated. Is that right? Maybe that's not right. I don't know. There are use cases which they're pretty separated, but maybe there are use cases they can be transferred. And also there's software layer to this, right? So right now, you can argue certain use cases, some large models cannot be deployed and the legacy chips, but doesn't mean 6 months later it cannot do so. As the software layer compression, model compression gets better, optimization gets better, things can change. So really understand not just the hardware configuration, this local supply demand curve for server itself, also the software layer. That's kind of critical, right? That's really changes supply demand curve and all the way to the user behavior. So it's going to take some time. So that's we have engaged with a lot of participants.
Yeah.
Make sure they have the right setup.
I have what is possibly a dumb question, but the compute futures, how are those actually settled? Because I have like images in my mind of taking physical delivery of like maybe one of those big
I'll give you a wafer.
chips.
I'll give you a server a wafer. That'll be fun.
Wafer.
So for the CME futures will be financially settled, just like the traditional oil settlement prices goes. Forward contracts, obviously we do forward right now at Compute Exchange, but we're always open to do physical deliver futures, especially given we do have Silicon Mark, which is GPU benchmarking. So imagine in the future you can do, hey, I want a 20 grade A B200 this configuration, this shape of servers in US East, and then at the end we'll get that. Well, usually API calls, so you don't get physical, and it's not as cool as physically give you a wafer, but you get API calls.
One can dream.
How do you literally trade it? As in, like, let's say there's probably some very bright people in the room now with an institution. When it's all listed and everything, does it need to go through like a futures broker? Is it like could it be like a prediction market where you just go to the website? Like, what is the actual? How does someone actually get in this? Setting aside whether they're sophisticated enough and whether they know what they're doing. A lot of people trade who have no idea.
Minor issue.
Yeah, setting all aside, yes, only trade what you know. But like, is it through a prime broker? Like, how will people actually be able to participate in this market?
The beauty of CME is you can do the same thing you're doing now, trading CME products.
Okay.
The same process, same margin. That's why you get great margin optimization, right? Everything is BAU. It's no different. We don't have anything right now.
So any commodities broker that someone has, they will be able to, on that platform, they will have access to these instruments.
Exactly right.
Got it.
Yep, we make it easy for people.
Would you be upset if a prediction market set up a GPU price contract of some sort? Would that eat into your business?
Not at all. So we actually worked with Polymarket last year. Someone actually listed my product at Polymarket without my consent. Last time. It's always start like that. And then someone told me that, and then we reached out to Polymarket, say, hey, do you want to do something, more real? So we did February settled and April settled a few contracts on Polymarket just to test the water, right? Obviously, we're exclusively with CME right now. But yeah, so I think, people have, obviously you have to do it right licensing, non-manipulative, right? All the right things. Yeah, market can do whatever they want. And then people will choose the best product for them to use.
Setting aside the financial instruments for the moment, would people think about AI and they think about the use of GPUs, they mostly still probably in their mind think of like OpenAI, Anthropic, and Google basically, and that's kind of it. But obviously, as you've stated, like the world of entities that serve inference in some form or another is much greater than these three companies that we talk about. Talk to us a little bit more about what the actual world of inference provision looks like outside of the big household AI names.
So the ones you mentioned, they mostly are closed source models, as we call it, right? But they do have some open source versions, but they're famous for their closed source models. So we actually track 300 open weights, closed source models globally from pricing and consumption point of view. It is really interesting if we have actually, we haven't really formally launched LM token indices. You can currently look at Bloomberg, and it's on Bloomberg. What's interesting is depends. It's all based on your choices. Mm-hmm. Right now, the price actually doubled from our indices from December 1st last year. It's like $2.21 per million token. It's a mixture of input-output token prices, average weighted by consumption by basket models. Mm-hmm. It's not here. This is GPU, unfortunately.
Wait, so since we have this specific chart up right now, the angle that I'm looking at it, I can't actually see. So what is the y-axis in this chart show?
So you're looking at the per GPU per hour rental rate on demand for 3 chips.
Okay.
The top one, the yellow line, is B200 Neo Cloud on demand per GPU per hour. Sorry, it's a mouthful. The yellow line is interesting, right? So every new chip we came out, based on historical data, A100, H100 usually came out to be high.
Okay.
And then comes down as more supply, came live, and then price came down and then stabilizes. So that's the trend we have observed for A100 and then for H100. So when B200 came out, we published the data last year at Bloomberg. Early this year, the price was high and then came down, which is kind of what I expected, but the slope was less steep than I expected. I was like, that's interesting. The slope wasn't as steep. And then quickly observed the price just came up. And now it's higher than the initial open, whatever you call that, right? Launch prices. That shows you demand supply curve in a different stage than whatever stage we had before. So the A100, the red line is H100, Neo Cloud on demand per GPU per hour rate. So you can see the price came down last year a little bit. Sorry about the scale, so you don't see much, but it came down and came back up quite a bit. I think the last 3 months came up to like 8% for the H100. The A100 is the oldest chips among the 3, right? They're pretty much a commodity at this point. The price came down, they stabilized, but the price came up about 10-15% for the past 3 months. Remember, they're A100, right?
Yeah.
They're not the latest and greatest at all. So this also tells you the supply and demand curve shifting.
Oh yeah, actually that reminds me, could you talk to us, because you're doing refurbishment of chips as well, right? Like, which seems like challenging in many ways and kind of reminds me a lot about like sort of Carvana model of compute or something like that. Like, how are you actually doing this? Like, how does that business work?
So this is cool in 2 different things. One is for people come to Compute Exchange saying that, hey, I want to, it's your new cloud provider, right? If you get a piece of land, you get energy, a co-location, great, congratulations. Then your option is, number 1, should I get the latest and greatest? The B300, the GBs, the Vera Rubin, wait for a few months, or do you want to get refurbished chips and turn it on maybe sooner, right? Then to you, it's become ROI calculation for the most part, right? What's your expected future revenue generation, what's your residual value calculation, how much you're going to purchase by, right? It's actually pretty simple cash flow based ROI calculation. So the way we approach residual value and the refurbished transaction is, based on ROI, this is your potential break even. Looking at H100, right? Obviously, you're not going to charge as high as B200, but your cost base is also lower. So you can do the future, as you assume, a few years of forward contract, you sign in 3 years, discount the cash flow back, that's your residual value now, right? So we do that calculation with people so they understand, hey, what's the value supposed to generate, and then what's the trading the market prices for refurbished or used GPU. Again, you have to test, you have to make sure things works, and there's other nuances to that. But we help people to the understanding of the whole residual value. And then that's why the whole bubble thing came about. But go ahead.
What month was it last year when like everyone got really obsessed with like the lifespan of chips? Remember,
November, December.
Michael Burry like tweeted something about, he's like, oh, the lifespan, they're like, right? And everyone was spent like 3 weeks free and then moved on from that conversation, right? Like that was like, what do we know about chip lifespans? Are there misconceptions out there about how long these can get be productive?
I got interviewed a few times, but I'm not important. I'm not important. But back then, I'm even less relevant. I was telling the reporters, I was like, look, I don't know what data you're looking at. Based on I actually have blogs on my website, which is completely, you can just search for it. Last year, because of that conversation, I want you a curve later on. The second year H100 resale value for refurbished chips about 85 cents on $1. So a year later, you can sell 85 cents on $1. That's pretty good, I would say. The third year is 84 cents on $1. And I think my car depreciated way more than that, right? And I drive my car for whatever, 10 years. So I had the data, but again, I'm not going to argue against narrative, which is...
So, but there's a fairly steep, a decent drop from year 1 to year 2.
That's right.
But after that, you see a general leveling.
That's November, December analysis. Right now, it's a little different. I haven't refreshed the study, but our code is there. If you're my data client, you can run my code, you get a number right away. Another thing I want to point out is L40s. They're like, the OGs, right? At that time, people still use them. They charge you, hyperscaler charge you 40 cents per GPU per hour. So, I don't know about 2 years where's the net number coming from, but I will do that trade every single day. You sell me your 2 years old at 10 cents to $1, I will buy it.
There's a sort of big question looming in the background of a lot of these discussions, which is the B question, I guess, whether or not we're in an AI bubble, right? And you sort of touched on it earlier. You have all this granular data on how people are actually using compute, GPU prices, all of that. What's your take on the big question?
So as an index provider, I cannot give any forward guidance. Nor do
Disclaimer.
I know. Nor do I know, right? In fairness, nor do I know. So the way I look at it is, we have defined a bubble, right? So if you look at stock bubble, right? And the Nasdaq shot up 200% and came back down to 84%, whatever back then. It's a bubble, right? The way I look at bubble is your valuation. Can your future cash flow support today's valuation of yours, right? So then I'm not talking about like OpenAI and everyone else valuation. I'm not VC. I don't understand that process. The way I look at GPUs, the machines, it's actually pretty simple. Look at future cash flow of your forward contracts, and then you discount it back. Can you get your money back for the price you pay? Right? It's actually pretty straightforward for the machine level.
Right.
But to your point, right? You can say, hey, what happened if demand dropped? No one gonna use your whatever things you have. But remember, the forward contract is a signed contract. If you have that, you kind of know. Obviously, if you have things, the biggest concern is people have concern overbuilt. If overbuilt, then by theory, then all your prices will come down because it's the oversupply of the market, right? So then you talk about supply-demand equilibrium. How do we know about the future demand of GPUs, right? I don't know that. Everyone's guess is better than mine, probably. The way I look at it is it's not that easy to bring any GPU online, right? You hear all those like big data center bill, $25 billion invested, but they don't translate to immediate GPU availability, right? You need the servers, which you have to be waitlisted. If you buy brand new stuff, co-location, you need optic fiber. So it's a lot of, unfortunately, star has to be aligned.
Wait, but people can default on contracts, right? So even if you have a long-term contract signed, like that could not work out. Could you envision like credit default swaps or something in the compute market?
So that happens in every other market, right? Every market, if you do OTC trade, you have the risk someone will default you, doesn't matter who they are, right? So there's a lot of mechanism to hedge that. The things you cannot hedge is GPU cost, right? The price you entered. So that's something exactly what CME Future is for. You can have the transparency and the liquidity and then the easiness of trading in and out and hedge your position.
Carmen Li, thank you so much for joining us.
Yeah, thank you. This is great.
That was our conversation with Carmen Li of Compute Exchange and Silicon Data. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow Carmen Li at Carmen Li. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, Cale Brooks at Cale Brooks, and Kevin Lozano at Kevin Lloyd Lozano.
And for more Odd Lots content, you should check out our daily newsletter. You can find that at bloomberg.com/Odd Lots.
And you can chat about all of these topics 24/7 in our Discord, discord.gg/Odd Lots.
And if you enjoyed this conversation, then please leave a comment or like the video, or better yet, subscribe.
Thanks for watching.